Hi everyone, it's Finance Meets Real Estate. So we have James Kandasamy here today. So he is the founder of Achieve Investment Group, and he's the author of, I'm gonna try to say it correct, Passive Investing for Commercial Real Estate. Was that the name? Yeah.
Yes,
And
passive.
yeah, so he controls through his company over 1,700 units of multifamily, 130 million assets under management. So he's going to talk about syndicated this deal risk profiling today. I'm very interested to hear what he has to say. And with that, I'm going to pass it on to James.
Sure. Can you hear me?
Yeah.
Okay, good. Hey all, let me just quickly go through my introduction. I think the resume need to be updated, but we basically own like 2,000 units, almost what 160 million in asset under management, and sometimes unit count numbers are pretty big numbers. No, I mean I can buy a 500 million all bad investment and say that I own 500 million asset under management. So all these numbers really doesn't make any. I mean, it gives you some indication on what we do, but it's not a big thing, right? It's not like create a perception that I'm a big guy, right? End of the day, it's all about how much returns we are giving to our investors. That's the most important, right? So I just want to make sure that I clarify that, because owning 2,000 units is a big thing. I mean, we own it as a single GP, right? We don't have any partners. I mean, other than our passive investors, we don't have multiple GPs in our deal. It's only me. And and we are also vertically integrated, which means we also have property management, we have asset management. We raise all the money ourselves, so we do everything ourselves. um, and sometimes that's important, because that gives us a lot of perspective in terms of what we know from end to end, right? When we raise the money until we manage, we know everything and we control everything. So just want to make sure that everybody understands who we are. um, and should we start with the topic?
Yeah.
Okay, good. So basically, I want to go through. I mean, I was talking to Stefan. Hey, what can I cover? I mean, we're talking. I mean, we can cover a lot of things, right? How to buy an apartment, which is everybody's covering that. That's the easy part. No, buying an apartment is not that difficult, right? But operating and executing a business plan to your pro forma or what you plan is very important, right? And that's really tricky, right? That is the marathon, right? Buying an apartment is just a sprint, right? So we basically are multifamily syndicators. Which we have like 45 staff working for us. We have like 3 or 4 corporate staff, and this topic would be a lot more on how can a passive investor profile a deal, right? When they look at a deal, how can they profile it? How they can put a profile behind that deal to match to what they want to have, right? What is their style? What's their investment style? Because a lot of times, you just look at a deal as a deal, right? Is the deal good? No, is the sponsor good? Are they good guys? Is the location good or not? Right? But a lot of times the investors, especially the passive investor, they forget that, hey, does it match how they want to have, what are the advantage that they want to take from that deal or not, right? So, and in case the power goes off, because we're going in and out in Texas here, I'm really sorry, but hope right now the power is on. Hopefully it's on for the next 20-30 minutes while I present that. So I was talking to Stefan on what can I present, and I thought this was a really good topic because this is very financial, and I think a lot of times there are people with financial background in this meetup, and we want to go through. So basically I have a chapter 8 in one of my video courses, which talks about how do you become an advanced passive investor. I mean, anybody can be an investor, right? If you just put 50,000, 100,000 into a deal and you become investor, and you go around, tell all your relative, all your friends, hey, I invested in this deal, 500 units or 200 units, 300 units, but that doesn't make you the most knowledgeable investor, because a lot of times syndication is private, and the numbers and all that, a lot of people do not know how to analyze deals. So I want to go into a very basic concept that I'm teaching my passive investors, and I want you guys to learn as well, on how can you profile a deal based on your risk assessment. So basically what we're going through is something called deal risk profiling, which is out of the 5 dark secrets that I put in this video series. I'm just going to go through the first one, which is, I think, is a very key one, because it's not being taught or being discussed in a lot of places. Do you want to put this in full screen, Stefan, or this is good?
Yeah, I think it would be better if you
Okay,
can.
is
Yeah.
it good? Can you see
Yeah,
this
that's
better?
good.
Okay, maybe you'll see the animation too, right? So it's called a DRP method, or deal risk profiling. And so let me quickly cover, when you talk about investment returns, like you have a purchase, you have three phases. I think someone's asking a question. Hold on, let me make sure I see that. Okay, good, thank you. They say much better. So there's three phases of investment. One is called the purchase phase, and the other one's operation, and the last one is sale of investment, right? So when we talk about during operation, that's where you get the cash flow, right? Year 1, year 2, year 3, until year whatever a sponsor is projecting. And the last one on the back end is where you make the sales, right? And commercial real estate, when you look at how it's being valued, right, at a Wall Street level, right? So when I say Wall Street level, it's not really Wall Street literally. I'm just saying in an advanced level. If you go to like BlackRock or Black Creek, or what's that, the big institutional guys, they value a lot more on the cash flow itself, because they said cash flow is always lower risk. So and also the back end, the high risk return, which is like 3 to 5 years from now, is always high risk. And the reason is very simple. Back end, because we do not know what's going to happen with the economy, whether the cap rate is compressing, or how the property is going to perform 5 years down the road. So it's always higher risk return compared to the cash flow. Cash flow is always lower risk return. And what these big guys do, they pay a lot. They split, usually when they look at an investment, they split this investment into two topics, into two segments. One is operation and one is sale of investment. And what they said is, I'm going to be paying a different amount for the cash flow versus what I'm going to be paying for high risk return. Because as I said, this is lower risk, is higher value, versus backend is higher risk, a lower value, right? So let me see. So cash flow is based on income and projected income of the asset. Last ones depend on the exit cap rate. So let me look at. So I want to introduce you guys a very quick concept called risk adjusted return. And sometimes a return may not be a return unless you associate risk behind it, right? So when someone said, I'm going to give a 15% return to you, right? But 15% return on a development deal versus on a cash flowing deal is two different risk profile, right? So same thing when you look at a value add deal where we're buying a distressed deal and we are adding value to it versus a cash flowing deal, the risk concepts are different. The risk profile of these two deals are different. So when you look at return versus risk, right, paradigm, on this side is lower risk, lower return, whereas in this side is higher risk, higher return, right? And I'm going to introduce a concept called IRR partitioning. Basically, it's helpful in choosing a risk-adjusted return investment. So basically, we talked about risk-adjusted return. Now we're going to talk about how are we going to measure this, right? So it's a concept called IRR partitioning, right? So for example, if you have two things, one is called cash flow, which is the cash flow portion of the whole investment. Remember, I mentioned just now. Whereas at the back end, which is called the equity appreciation, whenever a deal has a cash flow 70 to 100% of the overall return, which means the IRR. Right? IRR is a good measurement of return. But if you're seeing that 70% of that IRR come from cash flow versus equity appreciation, which is the remaining 30%, we can say it's called a lower risk investment deal, right? Which means it's a risk adjusted return is high, right? So the risk adjusted return, the return that is associated with the risk, because the risk is so lower in the cash flow, the risk adjusted return become high. The same thing when you flip it around, let's say cash flow become 30% and you're focusing a lot on the back end, then it becomes higher risk, right? So the risk adjusted return on this is low, right? For the same amount, let's say IRR, 2020, right? When you look at two deals, 20% IRR, 20% IRR, then you can profile it very well like that. But you can't compare it on a 20% IRR versus 25%, because now the IRR is different and now you have to look at it differently, right? So as I mentioned here, absolute return on high risk deal should be projected much higher value. So whenever you're doing a high risk deal, the IRR, when you look at IRR deal A versus IRR deal B, the deal B should, if it's a higher risk, because there's a lot more equity appreciation, the absolute number of IRR on that deal B should be higher when you compare. If you're comparing same to same deal A and deal B with the same amount, then you are basically, it's better for you to just do the higher risk adjusted return, which has a lot more cash flow, right? I want to stop for a while and make sure that, is there any questions?
Well, okay, so that's it. Like repetition.
We still have a few more slides to go, but I want to make sure that I'm
Yeah,
Giving opening up,
so
people ask questions.
I'm with you on that. I get it. But let's
Okay.
say how is it done in practice by companies like BlackRock, for example, in the sense,
Uh-huh.
okay, in the end, it, as discussed, currently becomes a little bit qualitative. Okay, so we have
Yeah, I'm going to go into the quantitative in a short while.
exactly, yeah. So do they have like then like more complex models for that, or I mean,
Yeah, there is. I'm gonna introduce an Excel spreadsheet where how you're gonna
okay,
calculate.
that's fine.
Yeah, because I don't want to be too much marketing fluff, because sometimes people say this is very high level. I
Yeah,
cannot do anything with this, right? So don't worry, I'm an engineer. We're gonna go direct to the numbers.
sure. And the other thing is, I guess, like,
Yeah.
is like in real estate syndications, and also for the audience as well, like, would you
Mhm.
say, like, because there is a little bit of an assumption, okay, the cash flow side is maybe is lower risk, right? It's more secure. But
Mhm.
is that really always the case? Because sometimes there can be like heavy underestimation of, like, let's say there is major capital expenses because you're levered in real estate, you're levered, your expenditures are levered. If you
Mhm.
need to put a new roof or whatever,
Mhm.
that hits you like very much. So if there is sometimes if
Mm.
those assumptions are not accounted correctly, I feel the cash
Oh
flow.
yeah, it'll kill your cash flow. Absolutely. I mean,
So,
I'm not talking about people making mistakes in their estimation of
okay,
rehab,
sure,
because that is something we can't control. I'm just
right,
talking about all the rehab costs, is being accounted correctly, right? This is
okay,
just
mm,
purely deal on a theory level right now, right? So on an operation, like, yeah, cash flow can come, there can be flood, there can be snow, and it can kill the entire thing, right? But whenever you're looking at on a behind a computer on a dash underwriting basis, especially for
right,
passive investors, everything is perfect, right? So we can use this model.
okay, got it,
So
thanks.
yeah, but if something unexpected happened, that throws out everything, right? So we can't do anything. So yeah, okay. If there's no question, we can go into the more detail. So IRR partitioning, this concept is called. It's very helpful in choosing risk-adjusted return in any investment, right? So what do you do is basically you have to evaluate the cash flow versus sale, which is the equity. And how do you do that is basically a method called how do you use a present value function. So present value, and I'm going to go in a short while, but basically you are converting all your cash flow throughout the year to day zero, right? So for example, deal number one, right? So if you have, if you look at this deal, you have year 0, 1, 2, 3, 4, 5 until 10, and you have invested 50,000. Let's say passive investors investing this, right? Then there's a cash flow from year 1 of 7,000 until the year 9, 7,000, until year 10, 7,000, and at the end they get 48,000, right? So basically net cash flow is basically, this whole thing is a net cash flow, and this is what we use to calculate the IRR, right? And I think IRR calculation, hopefully everyone knows about it. You just use Excel, right? Don't worry about the formula behind IRR, because it's not worth it for any exercise for investment, right? Unless you're doing a research, or if you're doing very detailed investment analysis, which 95% of the people don't do. So in this case, net cash flow, if you put in like negative 50,000, at the end you get 55,000, right? Because 48,000 plus 7, and you add all this as a cash flow, and you get IRR as 13.8. So the way you calculate the way you do IRR partitioning is basically this way, where you have a cash flow. Let's say you put in cash flow, and we use a function called PV, which is present value. So present value, basically what happens is it uses a function called time value of money, which is basically present value is equals to future value, minus, the inflation rate, or it's called a coupon rate or discount rate, right? So for example, a $1 today is not equal to $1 tomorrow, right? So $1 today or $1 tomorrow is actually equivalent to maybe 0.8 cent, 80 cent today, right? So that's what it's doing. So basically, if you look at year one, so let's say you're getting 7,000 cash flow. So year today, day zero is actually 6,152, and this is assuming the inflation rate, right? Whatever 3 to 4% of whatever we're getting right now. So same thing we are putting for every year, right? Every year we're putting in, and then at the end you got 70,000. Basically, you get like 36,813, right? So you basically get, so this is the cash flow portion, right, where you get total, and you get like all the whole thing. You do a PV over here, and at sale you get 48,000, right? So you have 46,000, 48,000, and that is PV is equivalent to 36,000, right? Today's value, right? So same thing, we split the cash flow side of it here, and then the sales side of it here, right? Sorry, 48,000 over here become equivalent to 13,000, right? 10 years from now, 48,000. If you backtrack to now, you get like 13,000. So what we did is we basically take, you know, this amount 36,813, which is a cumulative of this whole thing, and you take this 13,000, and what we do is we create a ratio, right? So the IRR is basically, IRR is partitioned into cash flow and sale. So this 36,000 of cash flow is equivalent to 74% of the overall return versus 13,000 is equivalent to 26%, right? So deal A has more consistent and very liquid. I mean, this is just explaining the deal. So let's look at deal B. So I want to make sure we go to deal A. So you understand, right? So when we partition this IRR into cash flow and sale, we split into 74% and 26%, right? That is the ratio between cash flow and the back end upside. So deal 2, keep in mind deal A has 13.8 IRR and deal 2 also 13.8, right? So deal 2, the way it works is, you know, in the beginning you don't have any money coming in. For 4 years you don't have any money, but if you see, like after that year 5, it's start paying 5,000, 5,000, 5,000. And in the year 10, you get a big lump sum here. The equity appreciates a lot because this could be a development deal or deep value add where, you know, there's a big turnaround happening. But the back end upside is like so huge, like 140,000, right? So if you look at a normal eye, you think that 140,000 is a huge number of money, but the sponsor is only giving you after 10 years. So the same thing we are doing it here, right? So this, I mean, if you do IRR calculation on this net cash flow over here, you still get 13.8%. So keep in mind deal A, deal 1 is 13.8, deal 2 also 13.8. So if you look at IRR level, it looks the same. But now you're looking at risk level, right? What is the risk between these two, right? So when you look at cash flow over here and you use the PV function, you know, you get like 5,000 is equal to 2,600, and you do each one of these, and you get overall, you know, 11,641 as the cash flow amount that you're getting in for past 10 years for the next 10 years. So that represent 23%, right, of the overall return. Same thing about 140,000 here. That is a big amount, but if you
Sorry to
go,
interrupt. Just a quick question.
sure.
What is the discount rate here? Maybe I don't see it on the slide. I'm not sure if it's there. Maybe underneath, or
Which one?
discount rate for the present value. Like, is it? It seems pretty high, right? Is it like 6, 7?
You said counter 8?
Yeah, let's say like for the 140,000 in 10
Uh-huh.
years, 38,000 present value.
38,000, yes, correct.
What's the discount rate there?
Yeah, it's using a discounted rate, yes.
Is it how many percentage points? Would you know?
That's a really good question. Actually, when I did this sample, I should have put it on the side. I can't remember. It could be like 6% discount rate or 7%
That's what
discount
I
rate.
thought. It seems to
Yeah,
be pretty high. Okay. Okay.
6 to 7% discount rate. I can't remember. I should have go back and see, because this is just sample,
So
and I
you're
did this
not
like,
aiming for just inflation in that discount rate.
yeah, it's not only inflation, it's a discount
Yeah.
rate. Yes, correct.
Okay.
So you basically are using a discounted discount rate to basically get the PV of that amount, and that comes to 38,000 over here, right? So, but when you look at this 38,000 on the back end upside on and a cash flow of 11,000, cash flow represent 23%, whereas back end represents 77%, right? So this is a very heavy on the back end side, right? So compared to the deal number 1, even though when you look at IRR is 13.8, but if you look at both of these, it's completely two different thing, right? Because the risk profile is different, right? Let me go to the next bullet point here. So comparing both of this deal, right? So both IRR is the same, but the risk adjusted return, you know, is different, right? So this one has lower risk, which means higher risk adjusted return, versus deal 2 as a higher risk because you're getting a lot more on the back end, which means, you know, it's a lower risk adjusted return, right? Um, and when you look at this two, I mean, when you look at return cash flow, so, you know, if you look at how, you know, the big guys are looking at this, they're going to say this is the cash flow deal is a much more, you know, valuable deal for them compared to a deal 2, right? But that's how you do the comparison, right? So, and deal 1 has higher risk adjusted return compared to deal 2 in this case, right? So yeah, this is basically an Excel spreadsheet, but, you know, it's pretty simple, right? So that's the very high level on, I mean, not say very high level, actually, we went pretty deep into the, into the board sample on how to measure risk-adjusted return on a deal, so that any investors, especially passive investors who are putting it into a syndicated deal, will be able to measure and how would they want. And of course, as I wrote in my book, the chapter, I believe chapter 2, where I talk about personal preference, right? So if you are a young person, you don't need the cash flow, you want to take higher risk, right? You want to look at more on the back end upside. Whereas when you are more late in your investment cycle, you're older, the cash flow is more important, you want to take less risk, right? So you can use this tool, the PV function, and deal 1, deal 2. You can see how to partition both IRR to see which deal map to your own investment cycle. And that's important because it's not all deals are the same, and you have to see what is your investment preference in any deals that you see. I think that's it. Questions?
No, that's good. Do you guys, if you guys have any questions, you can put them on the chat if that's easier, or you can just speak up. Either way.
Yeah. Yep.
Hey, James.
Hey.
Hope you're staying warm down there in Texas. When you present to investors, I guess either initially or kind of in a group setting, do you get to this level of detail at the beginning, or do you save it later on for kind of one-on-one conversations related to the deal?
It's more one-on-one if people want to really learn it. I mean, most investors wouldn't be so sophisticated to understand this. But as I said, I'm doing all this education right now, so people are learning about all this. But the thing is, during webinar presentation, we don't really say this is high risk or low risk, right? It's basically we present, we present our case and we tell them this is more, more cash flow heavy or more back and upside, and how do you mitigate, certain risks that we see in any deals, right? So that's the presentation, right? Maybe at some point, I'm going to create some kind of metrics for people to measure every deal, not only my deal, any other deals as well. They can see, okay, this is a 0.5 in the scale of a risk return, risk adjusted return, and it's suitable for me. Maybe the other deal B is a six points on the profile risk, right? So I need to create one. I need to patent that, I guess, right? So, I mean, I'm just doing all this education, so passive investors are more aware on why, how that each deals are different when it's presented to them, right?
So you touch on it very briefly, saying, hey, this is kind of heavy cash flow, or this is more higher appreciation,
Absolutely.
very high level. And then if somebody kind of piques their interest, you'll address that to them.
Yeah, but I do go into the strategies on how are we trying to do a value add on a deal. We go through very detailed as well, but I don't talk about risk adjusted return because it's right now it's still very subjective, right? But I do mention, when are we going to expect a cash flow? Like the last deal I did, I told everyone, please expect cash flow after 9 months of the deal closing, because we are turning around the property. So everybody is good, right? I mean, 3 or 4 months right now, nobody asked me anything, right? But on a deal where I buy, where I say that, month 1, you're going to get 8% pref, then everybody's going to be expecting that, right? So it's up to the sponsor on how to communicate when they're expecting the cash flow, what is the total return, where is the return going to be coming from, right? So that's all important information that any sponsor should let their investors know, so that people don't keep on asking you questions, right? When are we getting our pay? When are we getting our cash flow, right? So yeah, the business plan need to be communicated very clearly to passive investors.
Okay, thanks, James. Appreciate it.
Sure. Any other questions, guys?
I think I'm pretty good on this part with our petitioning.
Good. I think there's one more question on the chat. Can you share the spreadsheet? Well, yeah, send me a mail at James@Achieve Investment Group. I'll figure, because the spreadsheet, I mean, you can create the spreadsheet on your own. Right now, I mean, it's part of that, because it's part of the video series that I'm doing right now, but you can get the PV spreadsheet from anywhere, right? So, but it's the same spreadsheet as what you get over here, right? So yeah, if you can just mimic this, you should be able to get the same spreadsheet. You can create one. It's very simple to create one.
Yeah, I think it's just PV and IRR functions pretty much, right?
Yeah, yeah. Well, IRR is already given, right? So yeah, PV. Yeah, if you.
Right.
Yeah.
So,
And PV is an Excel function, right? So you can
yeah,
use an Excel to do PV.
sounds good.
Good.
Thank you, Jane.
Yeah, let me know if you have any questions. I'll stay hang out for a short while. I can answer any other question as well. I'm a multifamily operator, so we cover everything, right? So
let's say in your last deal, let's say, so one example, if we look at, so not on the financial side, but on purely, let's say, the marketing side, what is your approach to capital raising? Is it digital marketing primarily, building up your email list, or you have sort of already built kind of a deeper network of people, like via word of mouth? Like, what is your approach? And like, you use like Facebook ads?
oh no, I don't use any of those. I mean, I use all that, but all that is usually not effective.
Okay, yeah.
I think the most effective, I mean, the last deal that we did, we raised almost 12 million in 24 hours. Right.
In 24 hours. But then that has to be very technology based, right? That's the only way you can achieve it.
Well, I mean, people, I mean, this is, I mean, so when I say raise means people do commit how much they want to give, right? I mean, whether I use technology or I use investor portal, that's it's secondary. So basically we add a lot of value to people. I do a lot of education series. I do a lot of webinars. So I try to build trust using that, because I think that's very important to, to give value to people, right? People feel more connected to you. And like right now, the next webinar I'm going to be doing on March 11, I'm going to bring in a chief economist who is to present to the federal chairman. So he's going to present a week earlier. He's going to present to the Federal Reserve, and the next week he's coming to present in my webinar, right? So that's like you can't get that kind of access, right? And he's going to be talking about Bitcoin, how Bitcoin commercial. He's going to be talking about inflation. So that's a really good webinar, for anybody to attend. So I'd like to give free value to people, so people feel connected, right? At the same time, money is not the problem nowadays, so I'm not so worried about money raising. Finding the deal that makes sense for me is biggest problem right now, because anybody can buy a deal and anybody can raise the money, because so much money chasing deals. I think finding the right deal is the most important, right? Because it's very competitive right now on the commercial real estate space.
And what is your let's say, if you want to share with our audience, like your approach to that in terms of agent contacts, or do you use data?
No, yeah, we try to do things differently from everybody else. We don't go through, we don't go to the broker bidding, and whenever brokers send me on an email, the email blast to everyone, that becomes the lowest priority deal to look at. We'll try to go direct to sellers, right? Try to buy off-market deals where only one-to-one, right? So that's what I do. That's how I have some students learning from me. That's what I teach them as well, because that's the best way to find a deal that makes sense. If compare your time looking at like hundred thousands deal to find that one deal, I rather spend more time doing off market direct to seller marketing, because my time is more well spent compared to going through a bidding war, which is a very, very high pressure, and you are self bidding actually. So we try to buy deals which is off market direct to seller, or if it's through the broker. I mean, I buy deals from broker as well. I have a lot of respect for them. They will bring it to me, and they usually know that which deals that we can close, which deals we are really interested, what kind of deals that we like. So that are the deals we'll jump on.
Okay, and on the initial off-market data, like before you kind of make a prospect to those specific buildings, let's say, like on the initial data, do you use CoStar? Do you use Prospect Now? Like, do you use, like,
so yeah, we can use any database like CoStar or Yardi. In the beginning, I used something called a list source, because I was starting up.
Right,
List source is very cheap, like that, 0.5 cent per lead or what, right? But the thing is, the problem is not about using what database, it's about persistence. Right. If you look at any brokers, what they do on the office, they keep on calling sellers, right? That's what they do. But if you look at investors, not many people want to do the work, right? They just want to go to brokers and get the deal, right? So, but if you take over the job from the brokers and you start calling sellers, you have better chance, right? But to do that is a lot of work. So we are very persistent. We can use any database, but once we find the personal contact and all that, we are being very persistent in finding the deals. That's what we do.
That's good. That makes sense.
Yeah. Yeah, it's all about time factor, right? How much time you want to spend on certain effort.
Yeah, and I guess you eliminate the dependency this way on brokers, right?
Absolutely. Yeah. I mean, especially for newbies, it's very hard to get a deal that makes sense through brokers, because brokers have a lot of options, right? Why they want to sell it to a newbie and put their commission at risk.
Makes sense. Yeah, we have a question on the chat.
Oh, okay, that's a good question here. And Carlos. Okay, so will sponsors offering distribution on month one for value add? How do you know it's return on investment? Oh, that's a really good question. So that's my favorite topic: return on investment versus return off investment. That's one of the second. It's actually the second dark secret. Remember, I showed you guys like the 6 dark secret. That's the second one. So that's a big difference, whether it's return on investment or return off investment, right? So one is return off your own money versus the other one is return off a profit, right? So I think the question is, how do you know, right? The thing is, first you have to ask the sponsor, hey, is this a return on investment or return off your investment? Because it makes a huge difference in terms of risk profile, right? Return on investments, you're basically making profit. Return off investment, you're just getting back your own money or getting some capital back, right? So, conventional way is to return on investment, you make profit. But there are some sponsors who, also, over raise and pay back the same capital back to investors. And the way to know it is, first you have to ask them. And a lot of times the terms being used, like for example, if it's a profit, they usually say that, this is your, cash on cash. If they use cash on cash, that means your profit. But if they continue to use this is your distribution, okay, that's a red flag saying that that could be your capital. That's not really a profit, right? So you have to look at what term they're using. This is your payout, or this is distribution, or this is your cash on cash, right? So, and sometimes when they say this is a profit or what, right? And the second way to know is if you have an investor portal. Usually investor portal will differentiate whether it's a return off capital or return on capital, right? So my investor portal clearly delineates whether it's return on capital or return off capital. But I saw some other people's portal, and they don't even update the portal. They say, oh, the portal is being updated. They do not want to really show it, right? So, but the portal will be able to show whether it's return on investment or off your investment, right? And the third way is just ask the sponsor, is this profit or you're returning back from capital, right? And that's the way to know about it, right? What equity multiple do you target on light to moderate? So we usually target 1.8 to 2x equity multiple for our investors. Right. So, but a lot of it is based on pro forma, right? On the rent growth and how's the market performing?
Do you have like a target? I mean, I know it's
return. We usually target like 14 to 15% IRR for our investors.
Okay. Got it.
Yeah. And it's getting harder to do right now, but that's what we target for.
And in terms of, because you spoke on the risk partitioning, like, do you have a target, let's say forced appreciation percentage point, like at time zero, like what kind of price discrepancy or value add you're looking for as percentage of the overall, profit split of the deal, like sort of your IRR partitioning kind of.
Yeah, that's a really good question. I mean, when you talk about forced appreciation, the first 2 years is where you get the biggest bulk of your forced appreciation, right? Because we usually buy on a deal something called a built-in upside. That means day one, there's already an upside on it, but you just have to go and work on it. So we say like for next 2 years, we're gonna improve all this, and that's where we get. So I would say 80% of our appreciation come from the first 2 years, because we are doing a lot of value add. Right, and everything else is market, right? So, but market is very, very, you do not know what's going to happen to the market. We have just been lucky for the past 10 years. Multifamily has been doing very well, right? But they are distressed in the market too right now with COVID and all that. There are a lot of people having trouble, But in general, multifamily apartment investing has been doing pretty well during COVID and recession.
Mm-hmm. And in terms of, let's say, being like well capitalized, like how do you guys do that? Let's say between the investors' sort of down payment, so the closing costs, etc. Like what is your typical capital raises percentage of, let's say, the purchase price? Like would it be like 35% or would it be more?
Oh, you mean, yeah, usually we do like 20 to 35% of the equity, right? Of the overall price, right? That's the equity we raise. I mean, if you're asking about how much we raise additional to cover for rainy days, we usually do like 4 to 6 months of expenses.
Okay, yeah, 4 to 6 months of expenses. Let's say if your down payment, for example, is 25%, let's say how much extra, and again,
yeah, so the way we do it is, we do raise money for the rehab, right? But we don't really use it immediately for rehab. We basically we really be very careful on how much we want to use for rehab, right? So a lot of times, even though we do 100% rehab money, we only use like 70% of it. So 30% is always like a extra, right? So because we are vertically integrated, we can control what is being spent, right? We don't simply spend money just because the business plan calls for it, right? So and also sometimes we realize that to get that $100 rent bump, you may not need the $3,000 that you, or $3,000 or $4,000 that you planned, right? Maybe you only need $1,000 expenses to get that $100 rent bump. So it's very fluid, and we will see it during the operational stage.
And how does vertically integrated work with sort of like different geographies? Like, do you try to stick to like certain markets?
Yeah, that's good. That's a really good question. I mean, it's very hard to do, buy one deal in Florida, buy one in Texas, buy one in, it's very difficult to. So we try to focus on markets. So we are focusing a lot in Austin and San Antonio right now. Okay. So yeah, you need to group up, which is, that's where you get the benefit of it, right? So otherwise there's no benefit to go different part of the market to do.
And historically, like, were those your main markets, or?
Yeah. I focus right now. All my deals are in Austin and San Antonio, Texas.
Okay, sounds good.
Yeah.
And that's on the basis of, I mean, everybody invests in Texas or Florida pretty much.
Yeah, I mean, why you want to go somewhere else when you're already in your backyard is good, right? So, like for you, I mean, if you're in New York or New Jersey, you want to invest in Texas. No, it's good to invest out of state. But if we are already here, we rather invest in our backyard, right? No point.
Yeah,
it gives you a lot of benefit to know your own market.
True.
Yeah. Okay, so there's another question. You say going direct to seller for off-market deals. How can you tell which multifamily you should contact to see if they're ready to sell? Well, you wouldn't know which. Okay, so there's many ways to do it, right? So we use a few criteria to target multifamily that we are trying to target, right? One is, we look at how long they owned it, right? Because you can't be going after people who just bought deals last year, right? So we usually target like 5 years and above ownership, right? Second is, which market they are in. Third is, how, what kind of year build are, but how long they own it is the biggest thing that we do, right? And from there, I mean, this is how even loan officers contact you, right? How do they know your house loan is going to be due? And suddenly you start getting letters, you start getting advertisement, get a new mortgage from us, right? How do they know? Because there is a database that mortgage guys use to see when is your loan going to expire, right? So the same thing in commercial, we look for like 5, 7, 10 years loan expiry, and we start targeting them a few years ahead, because that's the time they start to refi, or they want to sell and buy a new one. So that's the time they start making decisions. So we use this few criteria to really look for who may be the potential seller. And we use a few other databases as well, which is there's a lot of things to be talked, but that's a very high level. That's what we do.
And so let's say, given you guys invest in obviously like markets that appreciated super nice, right?
Yeah, absolutely.
Austin
Lucky
top performer nationwide, right? I mean, amongst them. So given that though, when you underwrite your new properties, what is your appreciation assumption?
We usually look for 3% rent growth based on the market data. Let's say that market say 3% rent growth, we use 3%. Let's say 4%, we do 4%. But most of the time, it's 2 or 3% is what we target for. And usually we don't do year one, we only do from year two onwards, right? So sometimes people say year one itself is going to be appreciating 3%. So, that can give you a much bigger return at the end of the day, but I usually like to target, second year onwards, because first year is all about value add, right?
Right, understood. Yeah, so you base it off the rents, as that's sort of your income determinant. So does it mean you assume like cap rates, market cap will be the same?
It depends. So I know people say that, oh, you're not conservative if you don't do, cap rate is higher. Is that your question?
Like this kind of thing. I don't know.
Yeah. So we look at area where it's growing, where the population is growing. If the population is growing, then we don't mind having the same cap rate as today's cap rate, or even lower, right? If we won't take it from the air, say that, oh, you have to put 100 basis point more in 5 years, 50 basis point more. That's all plugging from the air. I know a lot of people do that. And I think, you need to be smarter about how you estimate what's the cap rate going to be by looking at where the population is growing. So we use tools to find which area of the city is growing. Where is it growing? Where is the path of progress? So if you find a deal on the path of progress, that means you can be more aggressive with your exit cap rate, right? But if you're buying somewhere where there's no path of progress, then you want to put, higher cap rate as well when you exit. So, you have to really see where the path of progress is happening to determine your exit cap rate.
Yeah. So would you say for your, I guess, generally speaking, on your previous deals, given how well Texas has done in appreciation terms, would you say it has been like appreciation has been, let's say, relative to your 3% assumption, has delivered, let's say, a higher percentage, I think.
Yeah, absolutely. So it definitely is higher percentage. But we can't generalize Texas in high level, right? Because there are deals even in Texas which is suffering. A lot of deals are suffering. If you buy it wrong, if you overpay, and if you have the wrong demographic in the wrong location, you're going to suffer, right? So I mean, Texas in general is good market, but we really have to go into the sub market and whether a sponsor is buying it correctly or not, right? I mean, you can buy one of the hottest market where you go through bidding and it's Texas, but if you overpay for it, it gives you very small buffer to make an error on it, right? But if you buy it right, if you buy it lower price, lower than what it's supposed to be, you already have a buffer. So that are the deals we target for. We look for really deals which has a lot of meat on the bone in terms of value add, and it's not being realized by the current owner. So we are going to go and do it because that gives the buffer for us, right? But there's a lot of people who buy in Texas who have been lucky because Texas market appreciated, but it's also very risky deals, like what they're doing.
Right. So undervalued deals, that makes sense. I mean, clearly that's the way to go, right? That's how you stay protected.
Yeah, correct.
Understood. But then what about the market itself? What
market itself has been growing like crazy. I mean, there's 356 people moving every day to Texas.
No, absolutely. Certainly, like it's looking great. But do you have some measures to assess, let's say, if the market is maybe overpriced?
Yeah, well, I mean, it's very difficult to really know whether market is going to be overpriced. Now, of course, we look for landlord friendliness, right? So that
you can look at some of my materials on that, actually.
Good. I didn't know. So we can, I mean, there's a lot of ways to really predict where the market's going, right? But, household income, income growth, household population growth. You can look at where's the crime rate is heading in that market. I mean, we do all that. But end of the day, whether you're buying it right or not is very important.
Yeah. Okay.
Yeah. If the market is strong, of course, there's a win behind your back. You get double bonus for it. So that absolutely you buy in the right market. But I'm just saying market's one factor. The other ones you have to buy it correctly. Because I know a lot of sponsors who buy in the hottest market and still suffering, right? Because they cannot turn around. They bought it wrong and they overpaid for it. Now they're suffering. But still the market is saving them. Because of the market, they are being saved right now.
Right. Well, you can do, I shouldn't go on that too much now, but you can do in the simplest way. You can just look at price income and like how it has been historically, how it is now. That's like the simplest way to go. And
which one is it? Is it income to rent?
No, that's gonna be worse. That's gonna be harder to. Okay, so what I do, and I've spoken on a few podcasts on that actually. So the best way to assess that I have seen, and that's purely on the grounds of what is actually predicting subsequent market drops. You're looking for a remainder term. You're not looking for, okay, affordability is very high. You're looking for, you have the prices, you want to normalize by income, you want to normalize by all the other, if possible, input factors such as population, housing supply, and you want to find that remainder factor, remainder that, okay, that's like sort of a bubbly component that prices shouldn't have, that's the unattributed factor, so to say. And if you do that, then if you do it, so you will find that actually it works very, very well in real estate. I don't know why people don't do it. Honestly, I can send you
send me something. I would be definitely interested to learn about it.
Yeah, and it's a very, I mean, that's the way to go. But the very simplest way is like just price income. Anyways, yeah, that's for different
price to income. You said
price to income and changes from some historical level, and that's going to be very, very predictive alone. Yeah. So for example, in 2007, like this metric like that was super correlated to the actual drops that happened, like 84% correlation at the state level.
Really, that's good. That's good. Yeah, I will be interested to learn about it.
I mean, this is one way to go. I mean, I've worked on like a more detailed, more sort of technical metric on that. But the very simple one at the state level works. The simple one doesn't work so well at the small geographies, like individual counties.
Okay.
But yeah, that's just something. But yeah, otherwise, of course, you're having undervalued deals. That's the
safest way, right?
Yeah.
Sounds good. Send it to me. I'll definitely want to.
I listened to it. You know, you guys have heard some of like Warren Buffett's lectures from, I don't know, the 70s or something like that, right? So one of his simple principle, you know, like not to look, right? Okay, so you
maybe buy... I mean, yeah, I think he buys that a lot. I don't know whether I'm following him or not, but anyway, that's the easiest way for me to
it's
be
like
comfortable with the deal, right? Just buy it under value, right? So
yep.
Because people ask me, you know, why? What about the economy? This is changing. That, I mean, because all that is very difficult to predict, right? So what you can predict is we are buying below the value. That's the most important. That's easy, but you know, it's also hard to find deals like that.
Hutch, do you have a question? I think you're waiting for it.
No, sorry about that. I had to hop off for a call, so I might have asked a question that you already answered. It would be great if will you be sending out recordings?
Yeah, I will. And I think I was gonna put the YouTube channel actually. If you guys can just please subscribe, and you're gonna have like the recordings there as well.
Yeah, and if you guys want to get my free book, which is called the Passive Investing in Commercial Real Estate, you can go to passiveinvestinginrealestate.com, passiveinvestingrealestate.com. I think you have to pay like $4 something shipping. The same book is $20 on Amazon. You can buy it on Amazon too. You know, it's that's like 85-star reviews. It's top 15 real estate book by Jim Cramer the Straight. So definitely people are reading that. Right? It's already sold like 2,000 copies on a full price, not on a 99-cent or free copy. Right. So get that. And if you want to connect with me, my website is achieveinvestmentgroup.com, ACHIEVE, achieveinvestmentgroup.com. My email is james@achieveinvestmentgroup.com.
Sounds good. And what's your webinar, James, for people?
Webinar, yeah, I haven't publicized yet, but it's gonna. If you guys on my email list, you know, you will get that webinar. That'll be a really, really good webinar because the last webinar I did with him, he's a chief economist. You know, we did like 500 people. Just my own network, right? I mean, I just published him because and people are like, you know, you get brain damage after hearing what he said, because he can really predict a lot of things because he knows, you know, he talked to Federal Reserve and all that, right? And yeah, that'll be a really good webinar. Right, so
okay, yes, sounds good. So yeah, somebody's asking to put the info.
Yeah, I'm gonna put here invest.
Yeah.
So any other questions?
Yeah, if you guys have maybe a couple of more questions, and we're pretty much running out of time soon. So thanks, James. It's been
Sure,
great.
sounds good. I'm happy to be
Stefan?
adding value to you guys.
Yeah.
I was gonna say whenever you post that YouTube page, it was directed to me, not to everyone.
Oh, did I? Oh, sorry. Okay,
That's fine.
okay. Yeah, thanks for that. Yeah. So
worries.
that's the YouTube. If you guys wanna check the recording of this or other events, please make sure to subscribe. That helps us actually quite a bit to manage the group. So
Absolutely.
thank you. Thank you. That's been
Thank you all.
I
And
learned myself today a few things. I hope everybody else did as well.
Yeah,
It's been a great
absolutely.
pleasure having you here today.
Really good. We go deep into the technicals. That's really good.
Absolutely. And yeah, awesome. I wish
All
you
right.
everything best. Thanks.
Thank you.
Hey, James, we'd love to connect and get you in the podcast, brother.
Yeah.
Would
Sure.
have it.
You see my email here? Can you see?
I see it. I just saved the chat. And for all who doesn't know, if you click on those 3 dots next to the chat, you're able to save the chat.
Oh, really?
Save it like an administrative runaround.
Oh, okay. Good.
Patch, yeah, we should
Good.
connect. I think I've seen your partner, like I forget his name, like neuroscience guy.
Oh yeah, super
Yeah.
smart guy. Dr. Jones, Heath Jones.
Yep. Okay.
Yeah.
Okay, sounds good.
He just went to visit his family over there in Waco, so he's in Texas right now. I think he might be on his way back.
Yeah, he must be stuck in the snow. There's 6 inches of snow everywhere here.
6 inches.
Which is crazy for us. It's not a big deal for you guys, but it's a lot big for us. So
yeah.
Awesome. All right. Hey, send me a mail, Shell, and then we'll connect.
Absolutely. Appreciate it.
All right. Thanks, Steven. Thanks you, everybody.
Thank you so much. Thanks,
All right.
everybody.
Goodbye.